Well, 2020 looks like it is going to be a boring year for the economy, and I'm going to talk about in this video why that is actually a really good thing. So when it comes to investing is not meant to be exciting, and it really is meant to be boring. And the less things that are going on in our economy, the bigger the chance that stocks will just continue to do their thing and keep going up, which we want them to do. So this is according to a Barclays top economist, and he says that a boring economy is setting stocks up for a winning year. And, no one knows what's going to happen in this following year, but he says right here that we're sitting on a trend of about 2% growth this year. And that's really in line with what the economy typically goes up in a given year. Now, anything could happen in 2020, and something crazy could happen in the stock market, could crash because of it, but based on what is forecast for 2020, it really is a good thing that the economy is boring. So I think that this is a really good thing for the economy, and I'm excited when things are boring. I don't like when when crazy world things are going on. We did have the stuff going on with Iran and the missile strikes, but the stock market didn't really respond too dramatically to those events. And I really think people are just enjoying the ride with the stock market right now. And we are in the longest bull market in history. And some of you, when I say that, some of you might think that because we are in the longest bull market in history, that we should start selling. However, there's another article that I found on CNBC, and it shows that the market's valuation, momentum, and speculative activity is nowhere near as extreme as in 1999. So let's go over and look at the S&P 500 over its whole history. So here's 1980. The S&P 500 was trading at $113.61. So if we highlight this whole bull market run, well, I guess we can't highlight the whole bull market run because I guess we're considering this little dip here as a market crash. Let's go ahead and see what that dip was. Okay, so let's just go from 1990. Let's compare 1990 up to 2000. We had an increase of 313% roughly. But if we include all the way from 1980 up to this point, it was up 1,238%. So let's compare that to where we currently are right now, and you can see that we are only up 331%. So the stock market from 1980 to 2000 was well over 1,000% gains during that time if we ignore this little dip here, because it's only like a 21% dip, whereas the drop here in 2000, 39%, and the drop in 2007, 2008 was 48%. And this is really important to understand and to realize that, yes, there's so many people out there saying, be careful, this is the longest bull market in history, you really need to sell your stocks, or you need to, just trying to induce you guys to be fearful. And I'm encouraging you to stay the course. I'm really excited for the next 4 years because I think Donald Trump is going to get reelected. And whether you like Donald Trump or you don't like Donald Trump, he is going to be a boon to the economy. He is going to keep this stock market rally going just because he's Donald Trump and he's pro-business and he does a lot of things to boost the economy. If you're listening to what a lot of the Democrats are saying, they're just not good economic policies. They might sound like good social policies, but they're not good economic policies. And so if Donald Trump is reelected, which I think he will be, based on the current Democratic field, I don't really see anyone that can beat him, then I think we're going to enjoy probably another 4 more years of strong stock market growth. And I don't want to bring up politics, and I'm not a political person, but I bring this up because it's something to think about when you think about your stocks. However, let's go ahead. The CNBC article is making the point that in 1999, 2000, right before the dot-com burst, the dot-com bubble, I should say, burst, and stocks went down. We saw it here. Stocks went down 42% roughly. That we are not anywhere near the high levels, the market valuation and the speculation activity that was going on then in 1990. So let me explain what was going on in 1990. Basically, you had the internet, the dot-com era, and people were creating these companies that were basically just websites. They were basically any website you can think of. Someone would buy a domain name, come up with a website, and then they would sell it to a bunch of investors and come out with an IPO, go public. And right here you can see in the article, it says in 1999, nearly 550 IPOs were sold to investors, and the average first day stock price gain was nearly 70%. So what you have to keep in mind with this era, or in 1999, what was happening was people were just making bogus websites. It was, if you knew how to open up a website in 1999, you were basically like the Elon Musk of of your day. And these weren't real companies. These companies weren't making money. It was just random people making websites or things like that. And obviously it collapsed in on itself. Let's go ahead and look. Let's Google really quick. I love Google. Google is great for researching things. Let's see how many IPOs were there in 2019. So in 2019, there you go. There's only 159 initial public offerings. And what an IPO is, for those of you who don't know, it's just when a private company goes public and the public can buy shares of that company. So that's one big thing that is a big difference between 1999 and now. Something else that is going on, it talks about valuation. And you can see here that it says equities are a bit expensive. Well, that's the argument, at least. People are saying equities are super expensive and you need to sell. But really, the S&P 500 is at its richest levels of this cycle, trading close to 22 times the past year's earnings. That is price to earnings. Right now, the S&P 500 is at 22. And compare this to at the peak in early 2000, it was at 30. So 30 times price to earnings. And that is a pretty big difference right there. And so I wouldn't worry too much about the P/E ratio, right, of the stock market now. It's good. It's a little high, but it's not terrible. And honestly, guys, this goes back to something that I talk a lot about in my videos. We really don't want to long-term investing. That's what I'm talking about on this channel. I am a long-term investor with the goal of investing over many years. And we really don't want to time the market. When the market's going up, we want to just keep putting money in. Keep putting that money in. Don't be fearful and don't say, I'm going to wait for the market to come down. We want to keep putting money in whether the market's up or whether it's down. And that's really what you're seeing here. Here's a chart that shows let's see, what is this? The Nasdaq Rally. And it's showing basically that the rise in stock prices from 1999 to now, it's a gentler rise. It's not as dramatic as what it was in 1999. So all of these things, guys, come together and show that really this bull market has a lot more, has more room to run. And another article I found from CNBC, and this is from just, financial experts. This one is Amanda Agati from PNC. She says that the worst thing an investor can do right now is take profits, and I totally agree with her. I don't think right now is a good time to take profits. I think you guys need to stay invested, stay the course. Again, I'm a long-term investor, and I highly encourage long-term investing. So with that, let's go ahead and take a look at my portfolio. I have retirement accounts and a lot of different investment accounts, but this is the account that I am the most excited about, and that is my aggressive growth FIRE portfolio. And FIRE, for those of you who don't know, it stands for Financially Independent Retire Early. And my goal isn't really to retire early, and kick my feet up on a beach somewhere. That's not really my long-term goal. However, I do think financial independence is something that I really feel that I can achieve and that I have the skills to achieve. And so this is a very high growth portfolio. What I like about M1 Finance, this is M1 Finance, there's links below in the description. You can sign up and open an account so you can start trading in M1 Finance. But let's go ahead and go to the research. And let's go to My Pies, and let's click on my aggressive growth portfolio here. And you can see over the past year, this portfolio is up 129%. And you might be saying, well, that's because you're only invested in one stock. And yes, I do have Shopify currently as, 45% here. I think it's 38%. Of my total holdings, so I'm looking to buy some more. But there are 60 holdings in this portfolio. So I have Shopify, which is my number one stock. I think this is a great stock to own, and I think that it is going to rival Amazon. I think Shopify could be a $1 trillion company one day, like Amazon and Apple and Microsoft. And so I'm putting my money where my mouth is, and I have close to 50% of all my money in this portfolio going into Shopify, and I feel great about that decision. And Shopify has been up almost 200% this past year, so of course I feel good about it, and I've made quite a bit of money on Shopify. However, Shopify is only a $50 billion company, so I think there is a ton of growth left for this company to get up to the $1 trillion mark. And this is a company that I want to hold for the next 10 years, 20 years, 30 years. We'll see what happens with it. Anything could happen, but right now I feel good about it, and I plan on holding it long term. I then have my growth stocks, and I have about 30 in this pie. I'm kind of way over diversified in this, but that's because they're smaller companies and it's just fun to pick stocks, and so it's really hard for me to control myself and only hold a couple of stocks in here. I then have my software as a service stocks, my SaaS stocks. These are companies that come up with software and then sell them on a subscription model. I really love these companies, and I have 18% of my holdings in there. Then I do have dividend stocks. I'm not a huge fan of dividend stocks, the legacy dividend stocks, I should say, because I think they tend to underperform the market. However, they are less volatile. So, my retirement accounts, I have a lot of dividend stocks, and my strategy is different. And that is because my time horizon in my retirement accounts is 30 years. And so there's no need for me to go and try to pick small companies and make, try to guess what's going to happen in the future too much. I can just, with my retirement account, I have the time that I'm just picking big, large, well-known companies, and I'm putting my money in there, and then I'm, basically not messing with it too much. So I have, mid-cap dividend stocks, which are just smaller dividend stocks that I think are going to outperform the market. And then I have some large-cap dividend stocks, and nothing crazy in here. Really, it's my big ones are Visa, MasterCard, Microsoft, and Apple. I have some NextEra Energy just to kind of smooth out my portfolio. It's a utility company, so its growth is not going to be tremendous, but it's very stable. So, I have 10% of 10% of my portfolio, so this is 1% of my whole portfolio. But that's my dividend stocks, and the reason I incorporate dividend stocks into this portfolio is because as this account grows over time, currently I only have, I'll show you guys really quick. Currently, I only have $21,000, a little over $21,000 in this account. But I have been funding this account every single week. I have been putting it on automatic transfers. And so I've been trying to put as much money as possible into this account to get this growth started, to get this FIRE portfolio going. And you can see over the past year, this portfolio is up about 29%, which is really good. Shopify has been most of my gains. And then my large cap dividend stocks have actually performed very nicely over this time. I have the growth stocks have performed well. My SaaS stocks have performed well. And the mid-cap dividend, I added these to my portfolio only a couple months ago, so they look like they're not doing as great, but they are still stocks that are going to outperform the market, and they're mid-cap, so they should outperform the large cap dividend stocks as well. But this is my 60 stock portfolio. This is aggressive growth. I don't really care about dividends. If anything, dividends to me are a negative right now because I have such a small amount of money. My focus is really on the smaller companies that can really have explosive growth. And when I pick explosive companies, let's go ahead and just go to my growth stocks pie here. You can see Roku. Roku's probably the most volatile stock I have in this portfolio. But when I pick stocks, I'm not picking tiny penny stocks. I'm not picking, billion-dollar companies. I do have a method to the madness, and it's really important, guys, if you're watching this video and you're building your own portfolio, don't look at my portfolio and just copy what I have. I'm really hesitant to reveal every single stock I have in here because I don't want people to just watch this video and copy me. I really think that you need to have a strategy and you need to write it down or at least internalize it and say, this is what I'm doing and this is my strategy and this is my plan and I'm going to stick with this strategy. So for me, I know that I can stick with this strategy because when we look at the risk of this portfolio, there's two things I want to talk about really quick. And that is that there's two types of risk when I was deciding what type of portfolio I was going to build, whether I was going to do dividend stocks or whether I was going to do ETFs or whether I was going to do this where I focused really on aggressive growth companies. And the thing is, like I said, there's two types of risk. There is risk that you can afford to take, and then there's risk that you can manage. And so the risk you can afford to take, that is basically saying, based on your financial situation, can you afford to take this risk? So for me and my financial situation, I have a stable job and I already have bought a house and saved up and paid 20% down payment on a house, and I'm on a 10-year mortgage on that house, the house I currently live in. And so I'm going to pay off my house in 10 years, and I don't have any car payments or anything like that. And I also have enough saved in retirement accounts right now to guarantee that I will be a millionaire if I don't contribute anything else to those retirement accounts. I already have over six figures in my retirement accounts. So really, this money I know I am not going to need. The other thing I guess that I would add is that my wife and I are very aware of the amount of money we spend, and we save a ton of money and we live way below our means. So I know that this money, my hope is that I will not have to touch this money for the next 10 years. I want to keep putting money into this account, and if something crazy comes up and I can't contribute money to this account for a period of time, let's say a couple months or something like that, then that's fine. But my goal is to not take money out of this account for at least 10 years. So I am operating this account on a long-term basis. Now, so that's risk number one. Can you afford to take the risk? I would not be investing this money in this way if I was trying to save up money for a down payment on a house or something like that. If I'm going to need this money in the next 1 to 3 years, I'm not going to invest it in risky things. And this, to me, these stocks aren't really risky. All stocks are risky, but it gets into the other thing that I'm going to mention here, and that is risk that you can handle. So you don't want to go and buy stocks that you know you can't handle the risk. And what I mean by that is you want to pick stocks that if they drop, let's say, Shopify, that's a great example. Shopify has dropped double digits in short amount of times. So if we look at Shopify stock, let's go ahead and just look at its total history. We can see here it dropped 22%. So do you want to make sure that you're not buying stocks that when they drop 22% or when they drop 30% or 40% or 50% in a month that you're going to panic and sell? And part of that is just kind of getting into the investment game and understanding yourself and understanding how you react to market volatility. But for me, if this portfolio drops, you can see here, if it drops, I think at one point I was down $2,000 in this account, and I didn't really care. So that's something that I want to mention with this, and that's risk. Is you need to make sure you're picking stocks that you can handle the risk and you can afford the volatility that you might incur. So let's go ahead and show. I want to show you guys something really cool about M1 Finance, and this is how I screen my stocks. So if we go to research and stocks, you can see that and this stock screener is not perfect. For example, I noticed MasterCard is not listed in the stock screener. You have to actually search for it. So it's not perfect, but there's almost 4,000 total stocks that you can pick from. So if you're trying to pick an individual stock, this can be a really daunting task. How do you pick 50 stocks out of 4,000 plus? And for me, I kind of decided, let's look at market capitalization. What I decided was, let's look at all of the stocks under 10 billion. There's 3,145. And what I decided was, or what I realized was that most of the stocks in my portfolio are really over that $10 billion range. I have some that are under $10 billion, but you can see if we put the minimum market cap at 10 billion, there's 718 total. And then what we can do is we can sort them by the highest price history in the past year, the past 3 years, and the past 5 years. So this is really useful for screening stocks. And we can see that if we scroll through this, yes, I own Roku. No, I don't own Snap. I own Shopify. I recently just added Insulet Corporation. I have AMD. I have Galapagos. I have Paycom. I have basically a lot of these stocks that are in that $10 billion to $50 billion range. And again, that's because my portfolio is focusing on aggressive growth. And so I want to pick companies that have smaller market capitalizations because they are the ones most likely to have the highest growth. And that doesn't mean that no big companies are going to have huge growth. I mean, let's look at Apple. Apple over the past year has gone up 101%, and they are the largest publicly traded company. The problem is it's really hard to guess which large company is going to go on a big run. And this channel, I'm a long-term investor, and I'm helping you guys outperform the market. And something that you're going to learn if you're an individual stock picker and you're trying to outperform the market is the more stocks you have, the harder it is to outperform the market. For example, if you just would have picked Apple, Microsoft, basically, well, hold on, I have to figure this out. Okay. Well, if you would have picked Apple, you would have destroyed the market. However, buying a lot of stocks, the more stocks you have, the more and more stocks that you hold means the more likely you are to just match the market. So if you're wanting to outperform the market, you're going to want to keep it to a smaller number of holdings. For me, I have 50 holdings, but that is because most of my diversification is in the small $10 to $50 billion companies because they're more volatile and they're going to change a lot, or they're going to go up and down a lot more. And so, yeah, so that is my portfolio, guys. Again, I'm a long-term investor. I'm going to keep putting money into this account every single week, and I am really looking for aggressive growth out of this portfolio. So if this is something that interests you guys and you want to keep up with my progress and see how this portfolio responds and how I'm able to deal with market volatility when the stock market goes down and when it comes up, and if you're just interested to see how this portfolio grows over time, go ahead and subscribe and hit the like button. And I really look forward to teaching you guys principles about long-term investing. And right now on YouTube, I see a lot of people talking about dividend investing. And I think that there is a lot of benefits to dividend investing. And I have a lot of dividend companies in my retirement accounts. However, I wanted to give you guys a different investment perspective for you guys that are younger, or you don't have a lot of money starting off and you want to try to grow your portfolios quicker. That's really my goal with this video, is to encourage you to try to beat the market, try to outperform the S&P 500, but do it in a way that's smart. Do it in a way to where you're not going to lose all of your money. And before I end this video, that's something that I want to talk about because I forgot to bring it up earlier. If we go back to this stock screener, let's go maximum of 1 billion market capitalization. So we're looking at all the stocks that have a market capitalization less than 1 billion. And you can see on our stock screener, that's 1,600 stocks. And if we go 1 year, so out of all of these companies that are under $1 billion, look at the prices for 1 year gains. 766, 523, 462. I mean, these are crazy. And it's very, very tempting if you're young and you don't have a lot of money to just look at this stock here. I don't even know this stock. It's a therapeutics company, and say, wow, if I could take my $1,000 and put it into this company, then I'm going to be rich before I even know it. And it's tempting, guys. I understand it, but you want to invest money for the long term, and you want to put your money in stocks that have a very low chance of losing all of their value. And you want to put your stocks into things that you understand. Or you want to put your money, I should say, sorry, you want to put your money into stocks that you understand, into companies that you understand. Because if you go put all of your money into this small therapeutics company that you don't know what it is, and then it drops 40% in one day, you are going to sell. I'm guaranteeing you that you're going to sell. And you're going to lock in that gain, and you're going to lose 40% of your money just like that. Whereas if you go invest in a Shopify or something like that, a company that's already established, is maybe a 10 to 50 billion market cap company that's established a little bit more, or is established. I mean, $1 billion company, it's not established. Whereas a Shopify, yes, it's a smaller company, yes, it's risky, but it's an established company. So if a Shopify for me dropped 40%, I can guarantee you that I'm going to buy more. Whereas if I went and just picked random stocks, tiny random stocks that have huge growth potential that I don't understand and don't know what they are, and they drop 40%, I'm going to sell. And I'm going to lose that money, because as soon as you sell, you lose the money. So I really want to encourage you guys to keep watching this channel and to don't invest in tiny stocks. Have a strategy and be a long-term investor. For me, like I said, a majority of my stocks are in this $10 to $50 billion range. And I think if you stay in that range, now you can go above 50 billion. I mean, I have Apple in my portfolio and stuff, but try not to go below $10 billion market capitalizations. I think that's a good rule of thumb. You can do whatever you would like with your stocks, but for me, I guess that's a rule of thumb I've come up with, and it's helped me out a lot. So this is like I said, this is a high growth portfolio where I do not focus on dividends or dividend growth. And I'm really trying to outperform the market over the next 10 years, 5 to 10 years. So I'm going to post weekly videos updating you guys with my progress on this portfolio, giving you long-term investing advice, talking about stock market news, all of that great stuff. So if you want that, if that's interesting to you, go ahead and hit that subscribe button and hit the like button. And I will see you guys next week. Thanks.